One of the things that I'm often asked when I'm helping individuals and couples prepare for retirement is, how will my Social Security benefits be taxed? So today I want to talk about how your Social Security benefits are taxed and some things that you can consider to potentially minimize that tax over your retirement. Social Security benefits are taxed based upon your income and your filing status. So if you are an individual, filing as an individual, and your income is below $25,000, you will not pay tax on your Social Security benefits. If your income is between $25,000 and $34,000, then you're going to pay tax on as much as 50% of your benefits. And if your income is above $34,000, then you will pay tax on as much as 85% of your benefits. Now, if you are a married couple filing jointly, and your joint income is below $32,000, you won't pay tax on your Social Security benefits. If your joint income is between $32,000 and $44,000, then you're going to pay tax on as much as 50% of your benefits. And if your joint income is above $44,000, then you'll pay tax on as much as 85% of your benefits. Now, it's important to ask, what is income from the Social Security perspective? So income for the purpose of this calculation is called provisional income. And you calculate it by starting with your adjusted gross income from your tax return. So you find that on line 11 of your Form 1040. But to that, you're going to add 50% of your Social Security benefits. You're also going to add any foreign interest that's exempt from taxation in the U.S. And you're going to add any tax-exempt interest, such as interest that you earn on municipal bonds. That total number is your provisional income, and that is what is compared to the brackets that I shared earlier. So what can you do to minimize your provisional income and potentially minimize the tax that you pay on your Social Security? There's some things that you can think about. One would be charitable giving strategies. When you hit age 72 and you have to take required minimum distributions, if you're giving to your church, you could do qualified charitable distributions. There are other charitable giving strategies that could help you bring your income down and still be carrying out the things that you're wanting to do with your money. Another thing that you can do is create tax-free income. Tax-free income does not get added to that provisional income formula. So any distributions from Roth IRAs, Roth 401ks, or if you have cash value in a life insurance policy, distributions from that might be tax-free as well. That type of income is tax-free. So you can consider Roth conversions. You can consider contributing to your Roth 401k or your Roth IRA. And then the other thing that you can consider is asset location. If you have taxable accounts and tax-deferred accounts, consider where you're going to own each and every investment. Where you're going to own the dividend-paying stocks, where you're going to own the bonds, where you're going to own the real estate investments. Consider where each asset is going to be held so that you can minimize the tax that you pay on that investment, as well as then help minimize the tax that you're going to pay on your Social Security benefits over your retirement years. So I hope that is helpful. If you would like to have any questions answered or get a second opinion on your situation, feel free to reach out to us, because we are here to help you be on your best path for retirement.